You ready? This will be an easy 30 minutes, dude. We're going to talk about tariffs, inflation, what's holding you back. All right. You just lead the way. Welcome back to the Behind the Well show. Roger Abel back in studio with Elias. Gonna have a good show today, Elias. I've realized what's really challenging about the environment we're in right now. Molly spends about a week getting an outline ready, and one day can completely change what we're going to talk about. And a little bit of it, you know, we record these shows about a week before they come out. And yesterday we saw the stock market go up. Well, it depends on what part of the market we are, from 9 to 12%. And just a lot can change right now in a really short period of time.
It can, and the market's really moving off headlines around the tariffs, which it doesn't always happen that there's one thing that can really get the market to move, but that seems to be what's going on, is trying to price the risk of what the tariff risk really is and how it's going to impact the companies. Are we going into a recession? There's a lot of uncertainty right now, and everything's changed. Actually, the news, you know, they used to talk about like the 24-hour news cycle. It's like a 6-hour news cycle right now.
It's a 1 minute. So I was literally on the phone with somebody yesterday who needs to take an unexpected distribution. And they have some cash, but they're a little short, and it's not a big amount. And I said, hey, you know, I would give this a little bit of time. And this is before the tariff relief, or whatever we're going to call it. I don't know what it's called, but before we reverse course on the original tariff plan. And I told them, I said, you know, this is one social media post, one news conference can change everything. And this is like at 12:02. At 12:26, I was calling him back and said, hey, we're going to go make sure we put that money you need into cash today. He goes, why? I go, right now the market's up 8%. I said, we're not going to be greedy. But that just illustrates how quickly it's moving. And then to second it, I'm glad we did it, because we come in this morning and the market's down 3.5. So right now there is just a lot of volatility, and you have to be a little bit cautious of even doing transactions. I think you had a situation the other day where a client had moved, switched jobs, and wanted to do a rollover. He wanted to get into his IRA. And what did you tell him?
That we should wait.
We should wait because it's too volatile to have that money in motion. People, you know, one of the issues when somebody does a 401k rollover, the money's out of the market for a period of time.
Right. And when you have heightened volatility like we do now, it's like on a normal trading activity, doing a rollover is really a non-event. You sell because you can't just move the investments in kind, they call it, right? Like you can IRA to IRA. Well, the issue with the rollover is you have to sell and go to cash. And in this market right now with this volatility, you'd have to get very lucky because depending on, well, what if we would have done it
Friday? Right.
We would have done it on a down day, and that money would have been uninvested. So then they miss out on the rally, the 10% day that we almost had. Well, some areas of the market up over 10. And now you're just making everything way more complicated than it needs to be.
One of the things, too, that we've been talking with people about, that is when the best days happen. And every advisor out there has access to this, and they're probably all talking about it. But the best days typically come after the worst. So I saw Monday, there was JP Morgan released some retail trader data. That retail traders at JP Morgan pulled $1.7 billion on Monday. Almost a level of capitulation, right? Because last Thursday, last Friday, it was all dip buyers.
Yeah.
And by Monday, They completely changed their tone. Tuesday, market takes off. And it really illustrates why trying to time the market just doesn't work. In fact, I had someone send me a podcast last night he wanted me to listen to. And I politely said, no, thank you. I said, this is an unvetted source. This is just a random person on YouTube. I get my information from pretty much four areas, and they're all what I would consider fairly politically unbiased, and kind of just straight to the point. And I told them it's CNBC, Bloomberg, LPL, Tom Lee. That's where I like to get my research. I like the guys from the compound for their candidness, but those are where I get it. And I was watching CNBC yesterday, and they're talking about the same stuff we are. CNBC, in my opinion, is a show. The channel, their financial information and channel really revolves around the trader, not the long-term investor. And, yesterday there was just a lot of talk about, the long-term investor, this was the opportunity, but this is also why the long-term investor shouldn't be trying to figure out exit and entry points. And you'll get a kick out of this. My wife this morning goes, well, maybe we should sell some and take some profits. I go, I'm not good at that. I said, I'm good at buying and finding entry points. I can't find an entry and an exit. And she goes, well, what do you mean? I said, well, I bought some individual stocks a decade, 15 years ago, 2010 timeframe, that I bought it and they went up in value and I sold them because I wanted to take the profit. I'd have been significantly better off doing absolutely nothing with them.
Holding.
Yeah, I didn't lose money. I had a great return, but I should have just held it. So I said, all I'm looking to do is buy and hold. And the only reason I'm going to sell is because I don't believe that business is a good business anymore. Versus I believe the stock price is going to go up. I'm buying securities or asset classes that I believe have a very good long time horizon. Not because I'm trying to make a quick buck, because as fast as you do that, you're going to get burned just as fast. And that's just the whole mentality of I can buy and sell and get in and out. I had people on last Friday, call me. Hey, I think we should get out. The market's going to go down another 20%. And went the other way.
How'd they know that?
Well, they didn't. But I called them yesterday and said, hey, market's up 8, 9, 10%, depending upon where you're at. Do you still want to get out? Because this is the opportunity. I get it. You're not back to your all-time high, but this is the opportunity if you're really scared to get a get-out-of-jail-free card.
Yeah, which would be, I suppose, not perfect, right? Because you didn't tick the top, but good enough. I mean, if that's really what you want to do. And
if you were ready to sell Friday,
right?
Why wouldn't you be selling when it's up 10? That's the perfect time to get out. But it just goes to show it didn't have anything to do with being able to stomach the risk. Had everything to do with thinking they could time the market and buy back in at a lower price.
And you can really break this down into, and it's an oversimplification, but maybe it's not. There's really two paths you can take. You can be an investor or you can be a trader. And guidance for long-term investors is going to be use market pullbacks as a better entry point for your money. Now, if you're a trader and trying to trade in this market, you got to be pretty good, and I think probably pretty cautious. But if you're a long-term investor and let's just say you're dollar cost averaging in your 401k, well, you put money in when the S&P was closing over 6,000 points, I would assume, right? As long as you had a payroll deduction during that period. So what's not attractive about S&P closing at 5,000 points for your new money going in?
You know what I did? I changed my payroll to put 100% of my paycheck in until my Roth 401k is maxed out this year. So
I think that's probably good behavior.
I'm trying to just turn lemons into lemonade. We're not impervious to feeling when the market goes down. I mean, we manage money for people. Our revenues come from the value of the stock market. Like all those things happen together. I think some people think that we're just kind of robots and it doesn't affect us, but it does. And we are investing money for our family, for ourselves. And I'm doing exactly the same stuff that I tell clients to do.
It absolutely affects us and impacts us, but we don't.
We have the data. We have the information.
We probably have probably a better ability to not be emotional about the situation, which people that work in this business tend to have.
Well,
but a lot.
I don't think we're less emotional. I think we're less reactionary. We have the same emotions. And I thought about this because
probably don't act on them.
That's right. We don't react or act on them. So they interviewed Tom Lee. And for those who don't know Tom Lee, he runs FundStrat, hedge funds. Most of Wall Street gets their research from Tom Lee's desk. Tom Lee even admitted, he said, Friday, I was very nervous that something was really going to break. But that didn't mean that he exhibited some unusual behavior, but he still had the same fears and nervousness as everybody else. We just have the discipline to not act on them.
I agree with that. And with over the long term, if you have the discipline to not react emotionally and make poor decisions, you're going to get a better result. I think if you react too strongly, you make poor decisions at poor times, that's how you end up with a mediocre long-term result for yourself. And if you're going if you have money invested into the equity markets and your thought process is it's always just going to go up, well, you're wrong. Over the long term, will the stock market appreciate higher in value? Yeah, I'm sure it will. It always has. But to think over 12-month periods, you can't have bear markets. You can't have corrections. You can't have, what have people been, a counter trend rally, which is what yesterday would be, right? We're trending in a bear market, but then we have one day with an exceptional rally. All that stuff happens, but that's all normal trading activity. So for your money invested for long-term growth, that you have to know that that's just going to be part of the game.
So you said normal trading activity. What's happening right now, truth be told, this is not normal trading activity. And it's really one of the reasons you shouldn't be making many changes right now, unless, your risk profile is significantly out of whack. The last time we've had trading days like this, I can name them: COVID, financial crisis, 87, Great Depression. Like this
Very
isn't
volatile.
normal trading. It doesn't mean, if you think about the long-term outcomes of all those point in times, they were all great entry points. They're all,
absolutely.
they're all great entry points when you have a long-term perspective of it. In the short term, it was probably scary for people to hold their investments or hold their stocks. And what people are really trying to do, they're really trying to figure out what's going on. This is how fast it's moving. And I think people need to understand this. There was an analyst yesterday that came out and revised their forecast to a recession and, lower their S&P 500 target dramatically. Okay. 45 minutes later, they completely reversed course back to their baseline expectation, which was no recession. I don't remember what the price target was, but it's 45 minutes and we went from one to the next. So if people out there think they're going to be traders and time the market, how are you going to do that if you're at a job? Like, are you dialed into the financial media all day long where you can just sit there and trade stocks? I don't know. I think those are the questions people need to ask themselves when they think they're going to try to time the market and do these different things. It's really not that possible.
It's not. And there's, in our volatility guide that we had made, one of the interesting graphs in there is,
if you want the hard copy, I got it right here.
Yeah. So one of the cool graphs in there, one I think is insightful for people, and yesterday is a good example, or April 9th, a good example. 50% of the best trading days, meaning market going up the most, 50% of those days happen during bear market conditions.
And
and what was yesterday? or April 9th. April 9th is one of the best days ever.
Right. Think about this. If you miss just the 10 best days, it lowers your overall return compared to the stock market by 20%. It's 10.9 in the stock market. It's 8-ish% if you miss the 10 best days. You miss the 20 best days. So if you miss yesterday, arguably you just chopped out a massive leg from your opportunity to recover. Now, if you got out on Wednesday, if you weren't in the market from Wednesday till yesterday, it probably didn't matter because you didn't suffer the 2 big days. But if you sold after the 2 big days, or you went into your 401k and said, oh, I have to make a change, you didn't do well. Here's the other thing that's really happening too, Elias. So I had a call with an older couple. They're nervous, rightfully so. And I said, I know you're watching the news, but your portfolio has been significantly less impacted than the S&P 500 because that's all they're hearing when they hear stock market. And they go, well, what's it look like? I said, well, we had a review in January and we raised $70,000 of cash to meet your distributions. They take like $3,000 a month. So I said, you have $70,000 of cash. The other 50% of your portfolio is in bonds, like fixed income, all short term, all U.S. Treasuries. And then this other chunk of your portfolio is in the stock market. But I started listing what they had. 15% in international. They had some consumer staples. They had some dividend payers. When it was all said and done, year to date, their portfolio is down 6%. That was before the rally yesterday. They're like, oh, that's not near as bad as I thought. And what it got me thinking about is diversification's winning again. For the last decade, if you diversified between different asset classes and you owned international and you owned value stocks and you owned mid caps and you got diversified like we teach people to do to lower risk, you underperformed. Because the last 10 years, all you had to do is buy the S&P 500. Well, that's kind of gone.
Or the biggest growth companies.
Well, and one of the things to think about is for the last 10 years, we were sitting in a zero interest rate environment. Interest rates have been as low as they've ever been. Well, now we're not in that environment. So at some point, aren't we a little silly to expect that what worked the last 10 years in a new interest rate environment that's north of 4%, that same thing's going to work for the next 10?
It'll be different.
It's going to be different. But I think the beauty is asset allocation and diversification is actually coming back, and it's not just buy these 7 stocks and you're going to be okay.
Which is probably that's a good lesson for investors, especially long-term investors should be happy that diversification's working again. And if the market's down 20 and you're not down nearly as much, even if your portfolio's okay, if the market's down 20 and you're down 10, you're still outperforming the stock market. Now, here's the issue though. Everyone gets anchored to their highest value, which is, as an investor, one of the hard things to overcome. But if you set your expectations on your highest value and gaining 10 to 20% every year based on that value, you're setting yourself up for disappointment. And your high value, although that's great, but that was a great time to either rebalance, raise cash. Like there were things that you could be doing to be proactive instead of reactive when the market goes down. And okay, the market, let's say if you have all your money in stocks, the market goes down 20 and you rebalance to a more conservative posture. Like, so what's your plan to recover back to your high value by doing that? How's that going to work?
It's going to be challenging.
That's what I'm saying.
I think the other thing, we're talking a lot about what's happening in the markets because our goal is to kind of calm some of the fears out there. At the end of the day, most people shouldn't be paying this much attention because by the end of the month, it could all be normalized. There's a little bit of fear and angst. I think a lot of it is, and people are saying this time's different, right? That's what they're saying.
People say that every time.
And every time it is different, because if it wasn't different, like what was starting everything, the market would clearly know how to react. That's what causes chaos. So of course it's different. But what have the outcomes been every single time? They're all similar. Really, I think one thing the general public really that is in the stock market, which I know this is true, majority of investors, retail investors, don't really know how stocks are priced. They just think they go up or down, right? How are stocks priced?
Earnings,
and then you apply a multiple. Simple. So someone asked me what was going on the other day. I said it's really simple. If the iPhone goes from $1,000 to $2,000, there's two ways to take care of the problem. Apple can eat it, which is going to decrease their earnings, or the consumer can eat it, which will decrease sales. Either one lowers earnings. So then you apply a multiple. That's how stocks are priced. It's based off what future expected earnings are, and you apply a multiple. So of course, if everything's going to be more expensive, people will buy less, or consumers have less profit margin. Eventually, what happens? Everything adapts, earnings normalize, and then they start to grow again. But people just think it goes up and down. And that's why when someone tells me the market's going down 20%, you know something that I don't, or that the market doesn't know. Because if the market was going down 20% more, it would already be there.
Certainly by the time the average person walking around would know that.
Well, no, what I'm saying is if the market had 20% more to go and somebody knew it, they know something the market doesn't. The market's already priced.
Right.
Like it's purely just a guess. And it's evident by all of the predictions that have been out there. Well, people have been predicting this for 7 years. It took 7 years to be right.
Right. And
we need to go back. We need to go back to Dow 16,000 for them to actually be right.
And even whether it's prediction, even analysts, estimates, they're making their best guess with the information that they have. But that doesn't mean that they know what's going to happen. And had we not had all this tariff uncertainty, we may be having a totally different year in the market. And that's the volatility in the issue right now is it turns out no one really knows what to make of it. And there's even, now I heard Jamie Dimon, CEO of JP Morgan, he was saying that recession is a likely outcome. Well, with all the things on the table, yeah, it probably is a likely outcome. That doesn't mean it is going to be the outcome.
So I have a question.
But notice he didn't say that's going to be the outcome. He's saying from everything going on, I can see how a recession would happen.
I think most people could. I mean, if you can see it, it doesn't mean it will happen. The other thing I'd like to know is when did he release that statement? Was it before noon yesterday or after noon yesterday?
It was before yesterday.
Yeah. So I can tell you there's many people have changed. If someone says, hey, what's the market going to do? I can't tell you in the short term. And if someone tells you they know, they don't know. They don't know. But what's it going to do 5-10 years? Here's what I looked at. I went back to the data of the biggest 2-day declines in the market. 8 out of 9 times the market's up 100% 5 years later. Only one time was it only up 88%.
When you have say that again, when you have 2 days of what?
The largest 9 2-day declines last Thursday and Friday was the 5th largest. The other 9 times, 8 of those, the market was up 5 years later, 100% or more. Only one time it was less. It was 88%. It was never down 12 months later. It was never down 3 years later. The 3-year average was over 60. The 1-year average is over 20. So if you're looking to take advantage of a situation, there's still opportunity. Like that's what I look at. What's a 5-year return? I'm sitting there going, man, if I put money to work today, this is last Friday, and this holds true, that's a double in 5 years.
Or the worst one was up 88.
That's still, hey, I'm still going to call that about a double.
Right, make 80% on your money in 5 years. And where else can you, with the amount of work it takes, right? You go invest money, you put it into the market, it goes up 80%. Like what level of work did you really do to earn that money?
Do you really want to know? I did an ACH.
Yeah, you clicked.
Did an ACH and I clicked about 5 other buttons and it was done.
Yeah, it's a few clicks of a button, right?
But I stayed completely emotional about it. Like I didn't care if the market went down more. I wasn't trying to find a bottom. I didn't care if it was the lowest. It was just time to deploy some cash. And we had other clients who did the same thing. You know, we had some clients who had some stocks that they had picked out that had done okay, but hadn't gotten creamed, that they rotated into different areas of the market.
Yeah.
And it turned out to be a good trade. But it
I've
wasn't necessarily going to happen, but they were willing to take that risk at this point.
Right. And we've had younger investors of ours call to take advantage of the downturn. They've called into ACH money. But I think that what's interesting is, a lot of times on the show we talk about like what's going on just in general. Well, in general, we already know that most people are not very good investors. Fortunately for us, we work with people who are successful investors. And, does anyone like to log in and see that their account is down? No, it's a poke in the eye every time that happens. But what'd they do? Oh, well, I have some extra money. I'm going to do an ACH and buy in. Well, 5 years from now, are they going to be happy that they did that? And are they going to care if they got the absolute bottom or somewhere in between, especially if they make 60, 70, 80% over 5 years? Are they really going to be concerned about that?
Well, and how much are they putting in? Even on 100,000, if the market went down 10,000 more and then you got the incremental benefit of that 10,000 because you timed it right, it doesn't matter.
Yeah, we're not talking about amounts that the net result's going to move the needle in your life.
To your point about adding more money, I actually had this thought too. One of the things that no one really talks about, but when there's volatility and people decide, hey, I'm going to try to take advantage of this and put more money in, inherently they increase their savings rate and didn't know it, because that money wouldn't have come into the market unless there was an event, right? They keep doing their normal monthly thing just like myself, but hey, there was an event that caused me to do something. So my savings rate just got increased for this year,
right? Yeah,
because of something bad.
Yeah, everything going kind of like as planned in normal volatility. People, they don't really want to chip off their extra cash.
So how many?
But the market goes down, and then they're like, well, maybe I could do a couple extra contributions.
Right? Okay, question. How many clients of yours got out of the market?
None.
Okay, I have one but they did it back in February. So they before the carnage started. I only know of 2 that actually said, hey, I can't take the pain, and we couldn't convince them otherwise.
Well,
and then one of it's not my customer.
Yeah, I mean, when you say get out, you mean like they just totally abandon. I mean, I've had over the last, even before the chaos, I had plenty of people like rebalance or maybe add some protection. And I had some people make changes at good times, but I don't consider that getting out. They're still committed to their strategy.
And here's what's really happened too, and it's really sad, Elias, but your opinion of where the market's going to go, or individuals' opinions of where the market is going to go, has actually become partisan.
Right now it's terrible.
Depending upon whether you're red or blue, that's driving your investment decision-making process, which is unfortunate, because I'm going to tell everybody, the stock market doesn't care what your political affiliation is at all. It doesn't know. So why would you build a portfolio based on that? Secondly, I told someone the other day, I said, hey, I'm not on the red team. I'm not on the blue team. I'm on the green team.
What's the green team?
We want customers to make money. I mean, right? That's what we're here to do. Because once you start to skew how you manage money based upon political affiliation, that's dangerous because the market doesn't care. So I really think today's show is just try to calm some fears for people, have a really candid discussion about what we think is going on. And truth be told, if you are a long-term investor, which if you're watching our show, you likely are because there are no stock trading tips here. This is just a blip on the radar. It's going to feel like a big event, but in 10 or 15 years, you're going to look back and be like, man, wish I would have bought more.
Well, and this, right, it's going to be a bump in the road. Watch, 10 years from now, we'll be doing content, whether it's TV, radio, podcasts, and we'll have a chart at that point, and we'll go, hey, in 2025, had you put X in the market when the tariff, and we'll say, hey, remember all the tariff volatility that was going on? Had you done X, the result would be this today. Do you wish you would have invested at that point? Because we do it with all that's a pretty popular topic for us, is looking at the most chaotic times. Had you invested and stayed invested, what would have happened?
Well, think about it. COVID, Great Financial Crisis, .com, Black Monday, just every single event that's been out there were all great buying opportunities, even though at the time it didn't seem that way because of the level of uncertainty that was in the market. With that said, if anybody is looking to get any advice, you can get us at btwellshow.com. If you're looking to get, we have a digital download, our volatility guide. It's really nice. This is a hard copy. If you want a hard copy, we're happy to get that to you too. You can call us at 800-383-6590 or go to btwellshow.com and get your free copy. With that said, just want everybody keep your head about you during chaotic times, and we wish you the best. Until next episode, thanks for listening.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure profit or protect against loss. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure profit or protect against loss. Dollar cost averaging involves continuous investment in securities regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets.